Hello guys, how's it going? Ricardo Torres here, Dividend investor. And in today's video, we're going to talk about the difference between index funds and dividend stocks. Which one's better, pros and cons of each one. I'm going to reveal all of that for you so that you can actually make an informed decision in choosing which one fits your goals best. Now, I'm going to assume that if you're watching this video, you already know that the stock market is possibly the best way to make consistently high returns with your money. But the question is this: how do you actually do it? Should you invest in index funds? Should you actually pick individual stocks that pay dividends? Which one is better, right? In this video, if you stick around, I'm going to reveal which one I think is better and my recommendations to you. But if you stay till the very end of the video, guys, I'm going to reveal two things. The first one is one index fund that I recommend, but also one dividend growth stock. And I believe each one of those has the potential to make you a lot of money in the long run. So that'll be at the end. Before that, let's get stuck in with the video. Alright, let's start with the basics. What are index funds and how are they different from dividend stocks? Well, basically, an index fund just tracks a certain index. An index is a collection of companies that a committee has chosen to kind of best represent an entire market. They're basically chosen because they're very good. So for example, the most famous index is the S&P 500. That stands for the Standard & Poor's 500. And that's a combination of 500 different stocks from the American market that are often benchmarked against other investments. So you'll have other investments and they will often compare their performance with the benchmark, which is the S&P 500. There's also other indices. For example, in the UK, you've got the FTSE 100. So that's 100 companies that are the collection of, the best companies in the UK, at least chosen by that committee. And there's also the Euro Stoxx 50, which is the same thing, but for a selection of countries in the European Union. Each one of those will have an index fund that will track the performance of that index. But before we go any further, we have to make the distinction between index funds and the mutual funds. People often confuse the two, so it's important to make the distinction. In contrast to a mutual fund, which is actually actively managed by a real human being, an index fund is all done automatically. It's done by computers and they simply track that index as closely as possible. So that computer will basically track the S&P 500 index as closely as possible, and whenever a company is added or deleted from the fund, it will do the exact same thing into that index fund. Okay, so if you buy that index fund, you will also experience that purchase or that sell of that particular stock. Now, in contrast, mutual funds are actively managed. They've got an actual person, they've got a fund manager, and that fund manager's entire goal is to try and beat the market. Okay? That fund manager will decide which stocks to buy into the fund, which stocks to sell, all right? And they will just try and beat the market. The only problem is that statistically, at least according to this article by CNBC, over the last 15 years, 92% of mutual funds have actually underperformed the S&P 500. Secondly, and this is a very big problem in mutual funds, is that they carry fees. Now, these fees are somewhere between 0.5% all the way up to 2% per year. Now, that might not sound like a lot of money to you right now, but that actually grows exponentially over time. So an index fund actually solves those two problems by just tracking the market. You don't need a fund manager to actually actively trade, right? So this, that person's salary is gone. It's just a computer. It's way cheaper. Therefore, their fees are much, much lower. You often see index funds with fees as low as 0.03% per year. That's very low. Even though it's a certain percentage, that's not going to cause a real dent on your wealth long term, so that's all good. And also, there's no risk to underperform the S&P 500 because it's simply tracking it. It's going to be, if not exactly at the performance of the S&P 500, it's going to be extremely, extremely close. Okay, let's now talk about dividend stocks, and in particular, dividend growth stocks. Those are my favorite kinds of stocks. They're stocks of companies that increase their dividends every single year. In contrast to index funds, where you actually own the fund and the fund tracks the index, so you actually part own 500 companies if you invest in the S&P 500 index, or 100 companies if you buy into the index fund that tracks the FTSE 100. In contrast to that, when you buy stocks, you own one company, at least if you buy one stock. The more stocks that you own, the more diversified you'll be. But initially, when you buy your first stock, you will not really be that well diversified. But the idea here is not to just buy one stock or 5 stocks. The idea is to, over time, and do like what I'm doing and build this portfolio that's well diversified, that consists of several companies in all different sectors and different currencies, so that you actually get similar levels of diversification as compared to an index fund or even a mutual fund. Okay, so we now know what index funds are and what dividend stocks are. But now let's get to the real beef of this video. What results can you expect from each? With an index fund, you'll do almost exactly what that index does, so pretty much what the overall market does. If the market shrinks, your index fund will shrink. If the market grows, your index fund will grow. The good news is that the market will normally grow way more than it shrinks, okay, at least in the long run. You should always have a long-term horizon when you invest. That's basically rule number one. But the actual figure, it really differs depending on where you find it. But from my own research, the market, a really good and reasonable estimation is around an 8% per year. Your stocks in that index fund, you can actually expect an 8% per year increase in the price of that fund, in the price of every single one of those shares, in every single one of those companies in that index fund. Obviously, past performance does not always guarantee future performance, but it's a pretty good indication. If something's been doing a certain thing for the last 90 or 100 years, it's quite likely that it will continue in that way. And when it comes to the world of stocks, that's pretty much my experience, that's the experience with pretty much anyone that invests in the stock market the proper way. Now, in contrast to index fund, where you can get that 8% every year, you can actually do better than that when you pick individual dividend stocks. And if you have a look on your screen right now, you can see that the light blue graph, that's companies that grow the dividends and that initiate the dividends. And those are the companies that I exclusively buy when I pick individual stocks. They have outperformed the S&P 500, which is the light green line, by quite a lot. This is from 1972 till 2018. Now, I personally average around 12%, if not more, from my individual stock. That's what my portfolio has done over the last few years, 12%. Now, I understand that we are basically probably at the end of this really long bull run. The stock market has been in a bull market for many, many years now. So I don't expect that 12% to be the average that I get. However, I think that a more realistic and probably a little bit conservative estimate of how, specifically picked dividend growth stocks that have a long history of increasing the dividends every single year, I think that will be 10% every year. That is my estimation. That's what I recommend to my clients. 10% every year on average from dividend growth stocks. That's a pretty good estimation. So basically you've got 8% with index funds and 10% with picking your own stocks. You might be thinking that 10% is not that much more than 8%, right? It's only 2%. It's not that big of a difference. But let me give you a quick example just to show you the vast difference that this can have. Let's say that you start with $10,000 today and then you invested $1,000 a month at an 8% growth over 40 years. Okay, that's the average working career for a person in the developed world. By the end of those 40 years, you would have $3.4 million. That's not too bad, right? I would certainly love $3.4 million, thank you very much. But that's not the end of the story. If all we changed was the yearly return, and we put that from 8% to 10%, after those same 40 years, everything else being equal, the amount of money that you would have would be $6 million. Okay, that's almost double the amount that you'd have at only 8%, which is really good, by the way. 8% is still very good. I just believe that you can do significantly better when you pick the right kinds of stocks. So now let's go over the pros and cons of investing in index funds and also the pros and cons of investing in individual dividend growth stocks. Before we get into that, however, please click like on this video if you're enjoying it so far. That really helps my channel to grow and I'll be really appreciative if you do that. So let's start with index funds. The main pros, I see 3 pros when it comes to index funds. First of all, they take very little time. You don't really have to know anything at all. You can just open a brokerage account, search for the specific index fund that you want to buy and just click buy. It's basically the same thing when it comes to individual stocks, but with an index fund, because you're buying that index, you're buying a selection of companies, it's just a lot easier. You don't really need to have all the knowledge to actually analyze individual companies. Another great pro is that you get immediate diversification. If you buy an index fund that tracks the S&P 500, you immediately part own 500 companies in the United States of America. You're instantly diversified. All of those companies will be from different sectors, okay? They'll operate everywhere in the world pretty much. So that is another great pro of index funds. And also you get good returns. As we have just discussed, you can get that 8% per year with an index fund. That's like the average yearly increase. And that might not seem like a lot, 8%, but at 8%, your money doubles every 9 years. So after 9 years, it's double. After 18 years, it's quadruple what you put in, so on and so forth. So that's pretty good growth for an index fund, okay? But now let's talk about the cons. And in my opinion, there's actually quite a lot of cons. The first one is called the basket effect. Sometimes companies or stocks will enter that index, okay, because they are chosen, and just because they're in that index and a lot of people buy that index, that actually kind of artificially increases the stock price of those companies, okay? So it's actually a bit of a negative effect. All the stocks that you own in that fund are not going to be absolutely prime class stocks like you could do with individual stocks. It's also way harder to analyze an index fund. When it comes to individual stocks, you can go to that specific company's website. You can see exactly how much that company is sold, exactly how they're doing, how much debt they've got. It's way harder to do that for an index fund. And come on, are you really going to go through 500 companies and analyze every single one of them? You're not going to. And actually, the only real information you get from an index fund is, its breakdown of companies, how many companies are in its sector, where they're located worldwide, and also the expense ratio and how well that fund has done over time. That's pretty much all the information you got. You can read it in 2 or 3 PDF pages. That's simply not a lot of information, okay? So that's definitely a negative in my books. It's harder to analyze. There's also fees that you have to pay, and even though in index funds those fees are very low, they're not really going to have that big of an impact, I still prefer to pay no fees, okay? And when you buy dividend stocks, apart from the brokerage, buy and sell fees, which you have to pay anyway when you buy index funds, you don't have to pay any fees at all, okay? Those stocks, you own that stock directly from the company, and that's pretty good. Also, not all stocks in that fund, in that index fund, will pay dividends. And if you're someone like me that just wants that cash flow, he wants that passive income in the form of dividends so that one day you don't have to work for money again, then an index fund might not be the best idea, okay? You'll still grow your money. It's still probably ideal for 70 or 80% of the people out there. But because not all companies pay dividends and not all companies in that fund, in that index fund, will be dividend growth stocks, you're not going to get that big a dividend yield. So you can actually get much higher starting dividend yields when you pick your individual stocks. And on the same vein, because you don't get that much of a dividend, you still get maybe 1.5%, 2% dividends, but that's just, in my opinion, not enough if you actually want to reach financial independence just with index funds, okay? You will need a lot more money to get that substantial dividend income, to get that maybe 3.5%, 4%, 5% yield, it would be very hard to get that with an index fund. So what happens is that most people that invest in index funds, they actually go by what's called the 4% rule. And I'll create more videos about this in the future, but basically that means that once they get the portfolio to the right size, they're going to sell 4% of their stocks, 4% of their participation in that index fund just to fund the life. Now, in my opinion, that's just not great because you're selling your actual money, you're selling your stocks, you're selling your assets, that asset that you should really be passing on to your family when you're done. And even though the 4% rule is not all bad, I just much prefer to only get those dividends and only spend those dividends, and my principal, the actual amount of money, my assets are intact, so that one day I can pass them on to my children and they can pass them on to their grandchildren. One last disadvantage that I see in index funds, and actually this is quite big for me, is that you can't really capitalize on opportunities. That's my favorite way to buy stocks. I like to see individual stocks that have been beaten down by the market. People, they've fallen out of favor. People don't like that specific stock. It could be one of thousands of reasons. However, I like to buy when that happens. I like to be able to calculate a fair price, and when the price of that stock goes well below that fair price, that's when I buy. You can't really do that with index funds. The price that you pay It's just the price of the fund, okay? And even though you can actually get better prices, especially if you do a thing called dollar cost averaging, where you buy that index fund regularly, maybe every month, maybe every couple of weeks, and you do that over many, many years, okay, that kind of averages your purchase price, which is a pretty good system to follow. You still can get those really, really good deals that I have personally got when choosing individual stocks. So I realize I've talked a lot about the cons of index funds, but don't get fooled. Index funds are still a really, really good investment, okay? I just think that, individual stocks, perhaps for some people, might be the better option. And let's now start talking about individual dividend stocks and their pros and cons. So we've already talked about a lot of these, but just to go through them really quickly, you can get better returns with individual stocks. I reckon you could aim for that, 10% a year consistently, 10% yearly growth. You can also find great opportunities, like we've talked about like 20 seconds ago. You just find those beaten down stocks and only buy when there's opportunities in the market. You also get higher starting dividend yields because you can actually select your stocks based on whether they pay dividends, based on whether they increase the dividends every year, which is actually key, guys, okay? If you watch more of my videos, you'll realize the companies that raise the dividends are much superior than other companies. Individual dividend stocks are also easier to understand and analyze. Like I said, you can actually get really detailed on that specific company. You can often find out the cause of why a stock has gone down because of, maybe the earnings hasn't been that good for that particular company, okay? I personally really enjoy that level of analysis and really being able to see what company you're buying. You're not just buying that index, fairly blindly. You are actually buying a specific company that you understand. And yes, that does take more work, but in my opinion, it's worth it. And that gives you full control, guys. When you own your individual portfolio of individual stocks that all pay dividends, you have full control. You might prefer to invest most of your money in REITs or utilities. You can do that. You've got full control. Yes, you can also buy certain funds, especially ETFs, exchange traded funds that only trade in utilities, for example, or REITs or consumer staples. While you can do that, I think the amount of control that you get with picking your own stocks, it's unparalleled. You're not going to get that amount of control with anything else. And finally, I think it's great if you want to reach financial independence, if you want to get to the point where that cash flow that you get from those dividends, from your investments, is enough to cover all your expenses, or even a big part of them. Imagine being able to cover 50% of your personal expenses just with dividends. You can do that by choosing your own stocks. You can still do it with index funds, but I think you need a lot more money to be able to do that consistently. So now let's talk about the cons of picking your own stocks. First of all, let's be honest, you need more time. You need more time. You need to have a better system. You can't just buy an index fund and forget about it. You need more time to read up on the companies, to do research, to find the numbers, okay? It actually doesn't take as much time as you probably think it does. In my experience, I probably spend anywhere from maybe 1, 2, 3 hours a month just to kind of staying on top of my portfolio, okay? Once you buy that stock, once you've analyzed that company, which again, maybe for each company, for each individual stock, I probably spend maybe 1 or 2 hours, okay? But once I've bought that, I just have to spend a very little time just to make sure that the company is on track. So even though it doesn't require that much time, definitely not as much time as a lot of people think, it still requires way more time than with just buying index funds. Another con is that you need skill to be able to do that. You need to learn where to find those stocks that increase the dividends, where to find financial information, how to calculate certain ratios that are really important, like the PE ratio or the payout ratio. You need to actually educate yourself. And again, in my opinion, it doesn't take that much. I've actually got a course on escapingtofreedom.com. I sell this course and it actually goes over everything, okay? In a few hours, you can know as much as I know about analyzing companies and finding all these factors. But yes, it does require skill. It does require more time than just buying, that index fund and basically investing passively. And finally, the last con of buying individual companies is that at first you won't have great diversification, right? Because at first, how do you start? You're gonna buy one stock, and then 2 stocks, and then 3 stocks. That's not great diversification. Over the first few months or the first year or two, you won't be that well diversified, you know, and maybe that's not as big a deal as some people think. Diversification is important. You know, one of your stocks is not going to go bankrupt in a few months. That's very unlikely, especially if you do all things right, but you don't get that diversification that index funds offer from the get-go. You know, you buy that index fund, you are automatically very well diversified. So when it comes to choosing the best strategy for you, I think it all comes down to how much time have you got and how much are you willing to put in. Are you willing to put in, you know, a handful of hours every month, which is not that much time, to actually get that 10% return instead of that 8% return? You know, for me, it's definitely a yes. I am willing to put in that time. I really enjoy doing all this work, but it does take time. It does take more time and it does take more knowledge. Whereas if you're just someone that wants that 8% every year to not really think about it, then index funds might be better for you. And to be honest, I think most people would be better suited to index funds. Now, that's not to say that you cannot do both things, and that's actually what I do personally. I also own some index funds, but the bulk of my own portfolio consists of dividend growth stocks. I just think funds are great for diversification, especially in different currencies. And now guys, as I promised earlier in the video, and as a little thank you for staying so long into this video, we're already gone past the 20-minute mark. I'm going to show you one index fund that you could buy, as well as one dividend growth stock that I personally love and own in my personal portfolio. Let's start with the index fund that I recommend. Okay, it's called the Vanguard S&P 500 ETF. The ticker symbol is VOO, VOO, and yeah, this is basically a simple index fund that tracks the S&P 500. You can see over here that it's got an expense ratio of 0.03%. So like I said, that's a very low amount of fee, right? Even though it's got a fee, it is still very small. If we have a look at the price and performance tab, we can see that over the last 10 years, it's done pretty well. So $10,000 invested would now be $32,000 invested. That's very, very nice. And actually the S&P 500 has done extremely well over the last 10 years. Its average return has been 14%. Obviously, earlier in the video, you know, I said that you could get an 8%, and you might be thinking, well, Ricard, you're wrong, because obviously you can get a 14%. But remember, this is only 10 years, okay? This is not likely to continue. It's just the way it goes, but, you know, still some pretty strong returns. You know, 1 year returns, 10.42%. So that's all very nice. Over here, we can see that it's got a dividend yield of 1.94%. So like I said, it's not terrible. It's not a terrible dividend yield, but I like my starting dividend yield to be at least, at the very least, you know, 3.5% for my entire portfolio. 1.94% simply does not cut it, at least for me, because I want to reach financial independence. But, you know, you are still getting basically a 2% return, you know, immediate return on your investment every year. And the stock that I will recommend is none other than Johnson & Johnson. I mean, this is by no means the best time to buy this stock. It's not a terrible time to buy this stock. However, just as a business, and when you buy stocks, you are buying businesses, guys, okay? That's like rule number 2 or 3 of investing, all right? Johnson & Johnson is just one of the best companies in the world. It's got a dividend yield of 2.88%. So again, it's not that big, but that's why I probably wouldn't buy it right now. I will buy it once the dividend yield got to 3% or a bit larger. But here's an interesting fact, guys, okay? You know I love companies that increase the dividends every single year. Well, Johnson & Johnson has been increasing its dividend non-stop for the last 57 years, okay? That kind of tells you what a great company Johnson & Johnson is, because dividends don't lie. To be able to increase your dividends that well, you have no option, you have no alternative but for your company to just generate a lot of money and just simply be a very good company. Now, just to end this video, I'm going to show you this real quick. If you go on the official Johnson & Johnson investor side, you can actually have a look for an investment calculator. It lets you put, you know, when you bought stocks and how much you invested and how much it will be now. So if you invested $1,000 in Johnson & Johnson stock, ticker symbol JNJ, in 1979, so we are now in 2019, that's exactly 40 years, you would now have around $79,000, which is a percentage return of 7,800%. Now, if we analyze that, because obviously that doesn't really tell us much, we need the compound annual growth rate. Okay, that's what really matters. And I did the maths real quick. That comes out to 11.5% per year. Okay, so that shows you what's actually possible when you pick just the best companies. And bear in mind, you know, Johnson & Johnson, 40 years ago, it was already a very good company. It wasn't just like a growth stock, and you would have had to be very lucky to make those 11.5%, okay? It was already a very, very good company. And in my opinion, Johnson & Johnson isn't going away anytime soon, okay? The products that it makes healthcare products, it makes consumer products, it makes medical devices. Those things are simply needed, and they'll be needed 20 years from now, 40 years from now, 100 years from now, probably, unless we've got nanorobots that do all this work for them. But, you know, that's the kind of company that you want to purchase, guys, okay? Okay, guys, that's the end of the video. Thank you so much for watching. I've got a question for you before you go, though. Let me know in the comments below. Do you prefer index funds, or do you prefer to pick your own dividend stocks? Let me know in the comments below. I'll reply to every comment. Let's start a conversation. It'll be fun. Also, please subscribe to my channel. I'll be releasing videos like this every week, twice a week, some weeks as well. So a lot more content. Also, like, subscribe, comment. All of those things really help me to kind of justify the work that I'm putting into these videos. And you know, that kind of tells YouTube that this video is valuable. So yeah, guys, if you've enjoyed it, comment, like, subscribe, and I will see you in the next video. Take care.